Ever pondered the role central banks play in monetary policy and economic stability? They're not just brick-and-mortar buildings filled with loads of cash. They are, in fact, the master puppeteers of a nation's economic stage, pulling the strings of monetary policy, currency valuation, and economic stability. Central banks employ a variety of tools to manage the money supply and interest rates. Open market operations, reserve requirements, and discount rates are just a few arrows in their quiver. They aim to control inflation, support employment, and foster economic growth. But that's not all. Central banks also step into the currency markets. By buying or selling currencies, they stabilize or influence the value of their currency. This action helps to counteract excessive volatility or rectify economic imbalances. Moreover, central banks are the stalwarts of economic stability. They manage inflation, support employment, and contribute to sustained economic growth. When financial crises strike, they act as lenders of last resort. Let's delve into some case studies to illustrate the roles and impacts of central banks. In 2015, the Swiss National Bank shocked markets by abandoning the Swiss franc's peg to the euro. This move led to significant currency appreciation, causing turmoil in financial markets. The Bank of Japan has a history of intervening to weaken the yen. This action aims to boost exports and combat deflation. We saw this in action after the Fukushima disaster in 2011, which significantly impacted currency valuations and global trade dynamics. During the Eurozone debt crisis, the European Central Bank implemented measures like bond buying programs to stabilize financial markets and prevent excessive euro depreciation. Similarly, in response to the 2008 financial crisis, the Federal Reserve implemented quantitative easing programs to stimulate economic activity and prevent deflation. Even the People's Bank of China isn't immune to central bank interventions. In 2015, it devalued the yuan to boost exports and address economic slowdown concerns, causing widespread repercussions on global markets. The impacts of these central bank interventions on currency markets are profound. They can lead to abrupt and substantial exchange rate movements. They influence market sentiment and confidence, and their actions have global spillover effects, impacting interest rates and liquidity conditions in major currencies. They also aim to control inflation and interest rates, key considerations for forex traders. So, central banks aren't just about minting money. They shape monetary policy, currency valuations, and economic stability. The profound impact of their interventions on currency markets underscores the importance of staying informed and adaptable in response to evolving central bank strategies. It's a fascinating world, isn't it?